Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We have a question about the Aussie yen, if you want to sort of comment on that one also.
It is a good proxy for carry. If I said it's not, then I misspoke. I apologize for that. But yeah, Aussie JPY, that's one that that's carry with beta. You're looking at the Japanese yen, which for so long was the funding currency when rates were low there. But as the U.S. dollars come down, really, if you have a choice to fund your carry trade with yen or fund your carry trade with dollars, all things being equal, the dollar is just a more liquid instrument out there. And so whether it be on the currency swap market or in general, the dollar just provides a more liquid base to fund that carry trade with. And in terms of the granularity of what the Fed's going to do versus what the BOJ is going to do, I think people are just more comfortable being short dollar and engaged in the Fed than they are engaged in the BOJ. Steve, I should do an option strategies for hedge funds webinar. Honestly, Andrew, I don't know that just option strategies. Period. A hedge fund is just a title. It's just a structure. We have this sort of perspective or viewpoint that like hedge funds are these amazing or this particular model, but they're not. It's just a structure that one operates and trades under. Typically. Historically, what a hedge fund was 25 years ago has changed rather considerably to what it is today. But except, people now, hedge fund managers, maybe not in the last year, but there's a certain rock star status that comes with that. But in reality, there's plenty of good traders that aren't trading in a hedge fund structure. They're just working for prop firms, show up in their shorts and t-shirt every day, trade for a firm, collect a paycheck, and call it a day. They don't have to worry about some of the regulatory components behind it and all the reporting that they just, up or down. AC. And a little background here. Andrew and I were part of a chat room about 9 years ago for tradingmarkets.com. It may be to this day the single greatest chat room I've ever been a part of in terms of the traders that were in there. Are some pretty influential names nowadays on the market. Many of them have actually come and spoken for the ISE as part of the educational workshops you do, which are absolutely great. When's the next one happen? In a day from 2 days, Thursday, right?
Thursday, we're doing back to basics. So we're going to start over and really talk about what's an option and all that. And I'll be giving a lot of, I think we're doing 8 of them. So that's something that I guess Andrew thought that might be something for later this year. So we'll see. Hey, John, would you comment on, I get this question all the time when I give presentations, the advantage or the perceived advantage for the hedge fund manager relative to the smaller investor. Many people, I think it's a myth, that they think that there's such an advantage. I like to think that, the smaller investor needs to understand, as you said, all the different strategies and the risks of the trades. But if you're trading, let's say 50,000, 10,000, what have you, it's a lot easier to get in and out of trades rather than trading, 100 million, a 10 lot and $100 million account. That's not going to matter, but a 10 lot in a smaller account does matter. Would you mind talking about how you would impact the markets if you're a smaller investor relative to being a big fish?
Sure, and just Carlos, Richard, and Preston, I see your questions. I'll go ahead and get to them in a second here after I answer Steve's question as well. But Carlos, Richard, and Preston, thank you for those. I'm going to first touch on Steve's question on comparing hedge fund structures or fund-to-fund structures versus just outright. And there's some positive and benefits to both, Steve. With a hedge fund, clearly you have the chance to commingle funds. All right. So in terms of me earning a pro rata share or a commensurate value of how a fund performs, and able to gain diversification and hire a manager that has a specialization, that's something that I can benefit from. Also, some hedge funds can receive, again, depending on how they're structured, certain exchange fee discounts that, again, from an economies of scale standpoint, you wouldn't get. Like I'll give you an idea. Like I have a Bloomberg which costs $2,000 a month. TT, $1,500 a month. CQG, $2,000 a month. Okay, my colos, my servers. So I'm talking $8,000 or $9,000 a month in software and expenses and whatnot. That because of the money that I manage, it's well worth it. Okay, it's just a cost of doing business. But if you have a $100,000 account, how are you going to justify a 10% monthly nut to cover those expenses, right? So those economies of scale for someone to invest in that and save their expenses on their own can really, be beneficial. Now, in terms of the sizing requirements, what don't you have with a hedge fund? Well, if I send my money to someone else, where's that capital at? That's with him, not with me. So now I lose control. Now I lose transparency. Now I lose liquidity. So really the best of both worlds is to actually, if you're an investor, if you want exposure to those strategies, is to trade in a structure that gives transparency to the investor, controls with the investor, and more like a separately managed account structure, but still lets you benefit from the economies of scale of having a fund. And so I think that's what we're ultimately seeing here, and what I'll talk about on Thursday at my workshop, as you can see from the information here, is the metamorphosis or the transformation taking place in the industry and the merge and evolution of those two subsets, i.e. a separately managed account or prop structure merging with a hedge fund structure to provide the best of both worlds. In terms of Carlos Silva asked, I've heard the expression volatility blow-off. Would you explain what that means? If so, explain. Tell you what it means to me. Naturally, there's a huge tick up in volatility, a huge explosion. You can see it happen like pre-big numbers, like non-farm payroll. You see the big uptick in volatility before an earnings release. The earnings release comes out, implied vol just gets smashed, what we call a volacost. And so that's often where you hear big volatility blow-off, or it's typically marked with market bottoms or a higher volatility environment. There's a volatility blow-off like on the downside. Volatility making new highs in the VIX is a much different sentiment or dynamic than than the VIX making new lows. So the volatility blow-off really refers to markets that see a big crash or see a huge uptick in volatility and then begins to dampen. In terms of what's a good vehicle to go short volatility on the dollar, I noticed the options on the EUI are very thinly traded. Like we just talked about, the EUI is definitely a product to get in there. Work and offer. You don't know how thinly traded the market is until a price gets hit. So I would say go in there, cut the bids. There's other vehicles out there as well. If you want to go short volatility on the EUI, maybe look for the YUK as well. Hopefully that helps you, Richard. Preston, know where you're going with that. Okay. Also for the euro as well, you can try the EUU. So give the EUU a call as well, Richard, or a try as well, Richard. Just remember that as well. Preston, in terms of what currency will be called the funny currency, it's possible. With all things being equal, with the yen and the dollar being, both at a quarter point or both basically at zero, the dollar is the funny currency. I think that like we saw from the non-farm payroll data on December 3rd, that dynamic, changed considerably, or at least began to change to the point that, in the last month, we've definitely seen a pullback in gold, a pullback in the euro. Not quite so sharp in Aussie, just because I think that the positive carry in Aussie helped mitigate some of that drawdown there. But nonetheless, though, I think the yen becomes the natural funding currency. And again, let's just see what happens with the British pound. Let's see what happens with the Canadian dollar. Let's see how the Bank of Canada acts, how the Bank of England acts. It may be a combination thereof, Preston. And what you end up with is a trade maybe like, short Canadian dollar, long Russian ruble, where you're going from high to low, maybe short CAD, long Aussie, short euro, long Aussie.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.